Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, March 17th, 2025. It's 1:38 p.m. Eastern Time. So I'm starting the video. I'll just go over some of the various things I'm watching. Not a lot of updates to give you on the broad markets. I've been quiet today. We had, of course, our buy signals on Friday. Clean and solid breakouts, as I mentioned early in the day, and then all the better when we got the solid, what I call a solid daily close. In other words, the downtrend line's there, green candle means you printed up there. You don't have to squint to see if you broke above the trend line or closed above it. Follow through today, so not much else to add. I've given you bounce targets, and those remain as is. So let's just go over the other indexes. QQQ is one of the big three I like to cover. SPY, clean breakouts on Friday, follow through today. Again, nothing new to add there. Just the fact we're following through is good in itself. IWM, gave you that as an individual trade idea as well. Gave you, what was it here? Yeah, I believe it was. That was my first resistance. I think it was on the 60-minute chart. You had the individual price targets, and we've cleared that first resistance level I gave you there, 203.32. We hit it earlier today. Friday. Friday was a breakout, and we've powered through that. And the way it works is, upon the tag of each initial resistance level, and once again, I believe I labeled that as R1, meaning first resistance, with these as the additional targets, meaning, in my opinion, it could have been a target and still, if you wanted to take profits, but to me, I'm swinging IWM. If it's a day trade, 1.5% is a decent trade, but a swing trade, that's a little too shallow. So that R1, which was 1.5%, has been hit and taken out, and that should open the door to the next targets there. Like anything, if you took it, if you took the breakout right here, you can set stops at break even. You can put stops below the previous low. If you're going to allow for a back test of the trend line, just remember the problem with that is it's a fairly steep downtrend line, and downtrend lines are dynamic, meaning they come in at lower and lower levels as time goes on. Therefore, it could be a pretty deep back test. We get that. So my preference, keep stops tight. The reason I started flip into a near-term bullish bias and saying the RR was no longer favorable, the extreme overbought conditions, sentiment, a lot of stocks still at defending key support levels, even though quite a few have been taken out. Again, I don't want to completely rehash all my analysis over the last week. Long term, a lot of breakdowns on the longer term charts, longer term sell signals increase the odds in the coming months. Plus, we're going lower. However, nothing, you don't go straight down forever. And so looking for that reflexive bounce, and then start to close out, scale out of those shorts and back into, scale out of those longs back into the shorts when that time comes. But also, as always, if it is a bear market that's begun now with more downside to come, always driving with the foot, one foot on the accelerator, one on the brake, ready to hit a hard reverse at any moment. And so that's that. So there's your, if you will, update on, again, not much to update. This is NQ. Yeah, that on NQ, I give you the targets as well. R1 was that first, I had the BOD, the main trend line, and the BOD trend line both taken out. You had that little W pattern I told you, basing pattern that we've been building recently. And we popped that today, and we're not too far above it. We're right now at 19,811, a little bit above R1. And so if we can take out today's earlier high, that should do the trick. That's probably where the shorts are going to start getting nervous and covering when, because there was a little fade at the close. You have to look at the 1-minute charts to see that. If you're trading today, you know what I'm talking about. We popped up. 1-minute chart right here. This is 1-minute chart. What you're seeing, this is your daybreak line. So there's Friday's close. This was this morning, a little pop up, little fade, profit taking. JCL shorts, meaning Johnny come lately shorts, still piling in, buying their SQQQ, thinking the sky is falling. That's it. So if we pop that, that's where they'll start to, probably stops all set pretty close to that previous high right there on the short sellers. And it also emboldens bulls and longs. You start getting the early makings of an uptrend. An uptrend in a security, any security, simply defined as that security making a series of higher highs and higher lows. And so far, that's what you have. So if you pop that high, that just keeps that near-term uptrend intact. Goes without saying, although I've already said it last week, that if the bounce materializes, you're going to see VIX pull back. I gave you some, potential pullback targets. But I also said, the time to go re-enter VIX long, if you did, like I did, cover those, sell those longs around T1 and site, plan to either short and or just simply stand out and look to buy back. Well, obviously you want to have a pretty decent degree of confidence that the bounce has run its course, especially, as I mentioned, I could easily see the potential for as much as a 6-7% bounce. And so far, I'm talking on QQQ and all that. And so far, we've only, it's about 3.5%. It's only halfway there. So again, there could be more downside. And that's when I start to get interested in going back long on the VIX, is once I start wanting to get short again on the market. So little level right here. You can see a reaction high. This is just my daily chart. You can go back to the 60-minute chart, which I gave you before. We've had this same target here. We hit it back on the last trade, the last pop in the VIX in pre-market. Again, you don't see it there, but I highlighted in pre-market so you could get out when that was hit. We went long there. We went long there. We milked that. We milked that, and we milked this so far, and for most we've been able to sidestep it, and so these are little micro levels there. But again, let's see what the markets do, and then I'll let you know when I think there's a good high probability interest in the VIX. And again, trust bear market. I trust bear market rallies about as far as I can throw them, but if they're there and I think there's more, I'm going to attempt to trade it and or remain out of shorts to not give back some nice profits on the last leg down. So if and when it becomes time to pivot sooner than later, I'll let you know. But other than that, my analysis stands as per last week. All right, what else do I want to cover for you? Well, the UNG natural gas that was told you just a nothing short as a phenomenal monster call from last year's lows to the penny, calling for since last year for a final target of 490. We hit literally, I think it was 4. You can see on the on the natural gas futures, when I queue up, and I haven't done it now, I did it that day of, remember it was Sunday evening, we hit my 490 target, and I made an unusual Sunday evening post to you telling you that was hit. Time to get out, take those profits. That was a long-term target I've been calling for since for nearly a year now. And right off the lows, massive trade in natural gas. And again, expect a tradable pullback, even if there's another potential higher target. But we're first going to at least have to have a decent, double-digit drop. And it's not reflected on the dollar sign natural gas chart from stock charts, because they do end of day and they don't realize that it didn't populate that 490 print that I showed you on the futures that night. I'm showing you right here because it was a Sunday evening print, and they must only use Monday through Friday data. And so again, I've said this once, I'll say it a million times. This is one of many reasons I trade futures personally, because a lot of the moves happen outside the regular trading sessions. I don't believe, to the best of my knowledge, there are any trades, even with the brokerages that have now expand after hours trading into, beyond the old school, what was it, 6 a.m. or whatever it was to 8 p.m. at night. And now you can trade, I think some platforms will let you trade through night and even on maybe Sunday evening, but UNG is an ETN, it's thin, and I'm going to guess that it didn't trade and allow you out that night. Now, of course, you could have got out the next day, you just would have nailed the highs. And on the reversal so far, if you did reverse it, certainly worth, in my opinion, taking that shot. Already good for, I'm just trying to measure it here, guys. Better than 20% off the highs from that point. And again, potential for a lot more if I step it out to a 6-month chart, 2-hour candles. There's the big divergent high, negative divergence. So when I get negative divergence on the 60-minute, 120-minute, which we're looking at here daily, and my long-term final price target is hit, that's a pretty good, reverse it up and take a, triple-digit gain swing trade, trend trade, plus all the little zigs and zags, and now turn it around and see if you can milk it out for another. What is that? That, right here, you can see there's a pretty likely target as well as right here, about 374. and we're below this trend line, so this should be the next, jog down there. And I wouldn't rule out a move all the way back down to here, a much deeper move, which would be a total of, if hit, about a 41% drop or a profit on a short trade. And just looping back to the markets and related things and all that. Again, I've said it before, to expect a rally in the stock market is to expect a rally in Bitcoin, most likely because of the correlation. Bitcoin's been a little sluggish lately, but remember, I'm going to do this. There's a lot of my trades that have recently hit targets. Bitcoin at the lows, to impunity, we hit our T3, my third target. I still maintain these additional targets, but if the bounce call in the market is correct, and we're going to get a little more upside, and I already gave you this would be a potential target, the downtrend line there, just like the downtrend line on IWM and everything else, potential max current bounce target, what I call max current, meaning, my charts are subject to change. If anything convinces me to extend my maximum preferred target at the time, 3-4 days from now, that's what it'll be. But that's still where I think we might go. And so, it's still an active short trade, but in my opinion, in my positioning, obviously it's an active long trade. Just the bounce came the bounce because I think we're going from point A to point. That's why I list multiple targets. A lot of, you listen to the bobbleheads on CNBC, they're going to give you their price target, quote unquote, on a stock, and that's no time frame, no nothing. It's just kind of a rough where they think it's going. My targets get a little more precise. I like to, when I don't game a bounce off each and every one. That's what I share, which ones are likely to have a bounce and why they're likely to have a bounce, and it all goes together. And again, you can make the case for a bounce in the stock market, then you can make a case for bounce in Bitcoin alone. But when you can say Bitcoin also has a 60-minute divergent low, very oversold, has fallen a total of about 30%. One of the hottest trades in modern history has dropped 30% off the highs. You're going to get the dip buyers that wish they were in before, and they're going to start buying, just like all those other high flyers that have gotten beat up lately, like Tesla and Alphabet and Apple and all that stuff. So, there's a lot I noticed, and I haven't been able to update everything. Active trades we've had on the side, longer term swing trades, UPS a week or so ago, and I marked it on my chart, but I don't think I covered it yet. We hit T1 to the button. Again, this was a trade we entered back here, right off support. Somewhere in here, could have been, let me check. To do that, and it was just a reply I made to somebody. Just make sure you get it. Blueberry, there's that earlier today. I replied to you on the RELY with charts and thoughts. You go to trade ideas and active trade longs, and you can sort them when they get there by symbol, and UPS down here. So UPS was, and again, there's quite a few. This is just one. So I first updated the trade idea on February 12th is when I threw it out to you. Long entry there at, what is that, 114.74 we entered it at. There were a few updates along the way. People asked if I still thought we'd hit T1 and whatever, and there's T1. T1's hit to the button. So, from right here, we entered at that point. Remember, I always say this, and it bears repeating for new subscribers. My targets way back years ago. I've been doing this site for a long time. I used to manually adjust the targets. I'd see the resistance at 123.75, and that's still the resistance I'd expect the reaction, but I'd temper down and I'd manually write down T1 would be 120, 348 or something, just a hair below, because sometimes the buyers will step in early, and my logic is, why try to milk out the last tiny fraction of 1% and risk a reversal? It's just something that evolved over the years. I guess, early on, after, being right on the call, but missing my limit order fill by a few pennies, I'll usually not try to milk out that last cent. But let's just see for shits and giggles where we hit. Here we hit a high of 123.70. There it is. There's a good example. My number was at 123.75. That's certainly effectively a hit. You can look at it. It looks like the candle touched it. Did we go to T2? Not so sure, really, honestly. All I can tell you at the time, when you hit that first target, and again, this is in the FAQ page created years ago. The reason I list multiple targets, upon the initial tag of each target, the odds of reaction are elevated. So the natural thing would have been to book profits, sidestep that 7% give back, recycling on the pullback, and again, expecting the markets to bounce. This one will probably have another leg up. Very few things correct in single wave. Even if it's a corrective wave, a bounce, probably get 3 waves up. No guarantees, but So I just want to update it if you're still in it. And then it's partner in crime. Before I intentionally avoided FedEx, I liked UPS better. Someone even asked. And so UPS is starting to look interesting. It has positive divergence. If I wish I had a better downtrend line or level to trigger an objective buy point, you have some support. You have this series of levels here, these reaction lows, and you can see I have various support lines. Look, I'm not crazy about it. I'm not taking FedEx. I just wanted to share it for those of you looking for trade ideas. And remember, be open to everything. I've said this quite a bit in the last week or so, that although I'm only expecting a counter trend rally and I have a higher degree of confidence my longer term targets will be hit, as always, I'm open to all possibilities. And one thing I guarantee you, and I've always guaranteed you this, I guarantee very few things. One guarantee I give you is I'm going to be wrong. I'll be wrong a lot. So if you take my analysis, use stops. Don't get married to a trade. I don't care how much I love it, how much I talk about it. It may or may not pan out. So the other guarantee I often give you is the news flows will change on a dime, and they will change after the charts. I mean, I just scanned an article today. It was Barron's or something about how traders were so dang bullish going into the beginning of this year. And I talked about that. And I was so dang bearish and said, watch. All it takes is a 10% drop and sentiment flips on a dime. Consumer sentiment will plunge. All the bears, all these analysts are going to come crawling out of the woodwork saying why the recession was off the table completely for 2025, and now all of a sudden it's back on, and they're blaming Trump and his erratic politics. We knew what Trump was. Come on, we knew all this stuff. It was stuff he said he was going to do. The tariffs are no surprise. It's just the market reacted. The technicals played out. We broke down from those trading ranges that we were watching. So, and now this is kind of that in reverse. Short of nuclear bombs lobbing around from the Middle East or Russia or wherever else right now, the headlines can't get much worse, all right, from what we've seen lately. So the risk to anything right now is a sudden reversal of the flow of news. Russia, Ukraine, U.S., Canada, Mexico, holding hands, singing Kumbaya, no more tariffs. All that stuff kind of goes away. I'm not saying that's going to happen, but I'm saying that's probably the greater risk to the market is a sudden reversal in sentiment and how everything's been flowing really negative lately. And all of a sudden everything's hunky-dory and you could see a potentially explosive rally that might take you beyond my targets. Right now, I'd be very happy to see a back test of this. The technicals are our best guide. I've said that before. If you're trying to trade off headlines, good luck to you. Sign up for Trump's little Twitter feed or whatever it is, or his Truth Social. Try to anticipate his next move. Try to anticipate the next thing that comes out of Elon Musk's mouth. Good luck with that. So, anywho, that's where we're at. So we'll just trade what we see, what's in front of us, and cautiously counter trend rallies. I typically don't trade as aggressive as I trade a primary trend down, especially once my degree of confidence high. Degree of confidence is moderate right now. It's up there. But like I said, I would just, and the weekend's over. I told you that too on Friday, and I did what I said I would do. I lightened up on Friday because I don't want to wake up to a massive gap down in the futures because I came into the weekend long. So this morning when everything looked hunky-dory, I added on the pullback, and that's it. And now, expect we'll probably break out of those highs, run, have a nice green close today, and if not, maybe tomorrow. Who knows? Where people are still nervous, and you get a little rally, they take a little profit. But remember, zoom in short term, like I gave you. There's that little basing pattern. If they can pop that, run up. A lot of folks will be looking to short the 200s. That's why that might be a little too easy, and therefore we might go through them to the upside if we can get some momentum, or we don't. Remember, the charts are pretty dang banged up on the longer term daily, weekly charts. So I'm not trying to get too cute, just trying to look today, tomorrow, see what the most likely scenario is, recognize where the potential is, where the RR is favorable. And I've said this once, I've said it a million times. If you are new to this, you don't know what to do, it's a good time to either paper trade, sit back on the sidelines, watch and learn, or trade things that aren't as volatile or aggressive, not as tied into the stock market. I still like the grains. I've liked them for a long time. They seem to be basing. We keep getting going. We hit some of the shorter term targets on the this is my wheat, the 60-minute chart. But here's the daily chart. And just like natural gas, I remember I started liking natural gas earlier in the year before it bottomed. It kept going in, retesting those lows or putting in a marginal new lows while the divergence got bigger, and then it finally just went. And I think that's what will happen with these grains most likely. Wheat's still lagging, as I mentioned. I think there's a differential to close or a game of catch up to be made versus corn, because wheat and corn tend to move nearly in lockstep, very close. And I've noticed that quite often when one or the other gets ahead of the other one, in this case, corn bottom back here has been making clearly higher lows, all the makings of a near-term uptrend since last August, right? All it needs to do now, and we already hit my T1. It was the same T1 from back here. Came, been bullish, and it's a long-term trend trade. It's back here. Went on, made a marginal new low. I addressed it at the time. It didn't exceed any reasonable stop measured using a favorable RR calculate up to that sixth and current final target, which may be extended. And so it's still, and then we hit the T1 level again. And now that becomes more important. This is where we need to just pop that. It'll do, not only is it resistance, it's really bringing some nice buying, but now it's also the previous reaction high. So if we can get another leg thrust up and take it out, it then solidifies. And for those that don't already see it, it becomes clearer to more that we are in an uptrend, i.e. a series of higher lows and higher highs. We just need to pop that high. Got a little ways to do it. We're not out of the woods yet, but and again, one of many trades. Either pans out or it doesn't. But again, it's completely uncorrelated to the stock market. So I'm trying to give you ideas. If this market's just chewing you up and eating you out, spitting you out, then these select commodities, long or short, you know what I mean? Crude oil, nat gas, energy commodities, ag commodities, industrial commodities, long one, short the other. The broad-based commodity ETFs, because of that, have been stalling out lately, and you're going to see that. There's a mixed bag. You need to be selective more so than usual right now, I think, in the commodities arena. All right, what's next? Let me just loop to gold. Haven't covered it a lot lately. It's been more of a hit-and-run vehicle. You keep getting, and for a long time, you get these divergent highs, and they're good. I'm just circling. It's a busy chart. I have a lot of horizontal lines. I'm sorry I don't have another one marked up, but I'm circling all. These are divergent highs, lows. Here, targets there. We nailed that one, shorted it down, covered it, went long. You can see we hit our fourth and final target there, hit our third target there on the bounce. Divergent low, correction, divergent low, or divergent high, correction, divergent high, correction, divergent high. I gave you 1, 2, 3, 4, 5 targets. We hit the fourth one, reversed. And that's really nothing much sense except this divergent high right now. So I always say divergence is not a sell signal, they're conditions. And if we go up much more on this 60-minute time frame, that divergence will be taken out. It would be nice if there was a little bit cleaner uptrend line. This is the one I'm going to give you. I'm going to remove this one here. And so if you're in gold or you're waiting for the next short trade, I wouldn't chase it here long. Yeah, it's at all-time highs. It's got a lot strong bid below it. But what I think is going to happen, guys, I think if we get more upside in the market, like I suspect in the near term here, this gold has been clearly a flight to safety bid, and that flight to safety bid reverses. What happens is people start selling, taking profits in gold and shifting back into stocks if and when they think it's safe to get back in the water. This is, again, the best trend line I can give you right there. And you can set an alert, and the sell of that will trigger a sell signal. And that's the 60-minute chart. Here's what it looks like on the daily chart. Big divergence has been building for a while. Again, divergence is not a sell signal, but what would be is a break of that. This is the same trend line right here I just gave you on the 60. So if anything, I mean, it'd be a pot shot. You could take a shot at an initial short here, give it a stop somewhat above, and then add if and when it breaks there if you want to get in the aggressive trade. Or, trade for the juice. You go to GDX, you go to the miners or silver, you get more bang for your buck. But see, silver miners, I'm sorry, that's FedEx. That's not GDX. GDX right here. setting up big negative divergence. So also would not be chasing the miners here. In fact, on the contrary, I'd be looking for the, this will be the next trade I'll make in these guys. I have no position right now, will be on the short side most likely. And I might get ahead of the breakdown of this trend line in gold right there. There's a much shorter short-term, yeah, there you go, this short-term steep uptrend line right here on the 60-minute chart. Not one of my favorites at this point in time, but I just want to throw that out because I usually, after doing these videos, someone will ask for an update on gold. Probably, other than the stock market, it's the second most requested security I get over time. Stock market's usually number one, gold and the miners number two. I don't get a lot of updates on I've been giving you updates on Bitcoin, but I don't get I think there's as many Bitcoin bugs here as elsewhere, and done a pretty good job over the years. I think an excellent job of catching the big tops and bottoms in Bitcoin. All right, and currently long that because I'm long the equity markets. So as I said, they should bounce together, and I think Bitcoin might even outperform. It's been kind of lagging lately. Probably some short covering to be had there. Alrighty, what else? There's a gazillion and one things that I've noticed recently in trade ideas, other ones that have hit targets. I'm trying to think and recall right now. I don't have a clean notes in front of me. Coming off that week of kind of quasi-vacation last week. I know AGO was one. AGO was one of the bond insurers. Hit T2, reversed. Again, everything, this is last week. It's time to cover up, take profits on shorts, especially those that have hit targets. And some of the other bond insurers, one of the other ones, but that they've gotten knocked down a lot. I want to show you, there's another one, AMBC, that I follow. I follow MBI, AMBC, and AGO together. This one, now, by the skin of its teeth, it has a big divergent low, but more so, this thing's gotten the snot knocked out of it since that last divergent high. And I believe I covered them in videos back here and might have even floated that as a trade idea. This is just showing you the cracks. We're finally seeing the strains starting to emerge in the credit markets, which I suspected would come. I've been saying for quite a while that one of the biggest risks to the financial markets, including the stock market, is what I consider underpricing of risk, credit spreads being way too low, not reflecting the real, what I believe to be real risks in the markets. I don't think what we just had is enough to flush out and rectify that. I'll take a look at credit spreads later, but you can eyeball them by just looking and seeing what treasuries are doing. Credit spreads, for those who are not familiar, just the differential between what a safe U.S. Treasury bond is paying versus below investment grade, low grade corporate paper or bonds, that is. And that's IEF. You can see lately, kind of holding. There's a flight to safety bid. Stock market just had its biggest correction in months or a year or more. So bonds went up, of course. So flight to safety bid, I talked about it much. And then JNK and LQ. JNK is one of the big, and HYD are the two big. I think it's HYD, the two big HYG bond, junk bond ETFs. And you can see over the time that was falling, so that's reflective of credit spreads. If you're new to this too, just know this, and this isn't anything new. Goes back to my stockbroker days in the late 90s. That it was just well known that junk bonds, even though they are bonds, they're in a fixed income asset class, they actually trade much closer to equities. They trade along with the stock market because they're not sensitive to changes in interest rates. They're more sensitive to changes in credit conditions. Because when the economy turns, especially goes into recession, default rates start to spike on junk bonds, not so much on investment grade bonds, which are high quality, AAA, AA, even single A rated bonds. And it also stands a reason. I haven't covered bonds much lately, but yeah, if there is if the markets bounce, this is IEF here. I don't have strong opinion nor a position right now, but you'd probably see a little bit of reversal. This is that flight to safety bid here in treasuries with the stock market going down. So, in other words, the more the stock market goes up, more likely you are to see this go down. Now, there are a lot of moving parts right now with the bond market, more so than at many points in history, and that is mainly the fact of at some point it's been increasing in recent years, especially recent months, the federal government's ability to repay its debt. You know, the U.S. government's not going to do a outright default. They'll just do a tactical default, which means when their debt service loads, Washington's going to continue to spend and spend. Say what you want about Trump and trying to doge and the whole cut fat in the government. Trump is every bit as much a spender as Biden was. All right. So he just wants to spend in different ways. So we do not have a fiscal conservative in office. So, and that's not good for the deficits that we've been running. And you couple that with a recession, forget about it. I mean, the CBO is trying to budget out how the deficit's going to look and all that going forward, using crazy assumptions that we're in perma expansion mode, and recessions have been banned since the Fed decided they could, you know, hit the nuclear button back when the 2008 financial crisis. They did it again when COVID hit, and and the markets began to think they were omnipotent, and they can anytime they want just take rates to zero and flood the system with money from quantitative easing. And that worked great until it stopped working, and it stopped working. They realized that, guess what? Milton Friedman was right. You keep printing money, you're going to cause inflation. So the Fed's been checked on that. We now know that. We know what happened last year with the historical three rate cuts in a row, and bond rates went exactly the opposite direction, long-term rates. So Fed realized, and we better stop this. We really mucked up here. So there's that now. So what I'm trying to say is, don't expect Uncle Powell to come to the rescue again the next time the stock market drops 30, 40, 50%. Their hands may be tied, and will likely be tied to a greater or lesser extent this time around. So, but that's down the road. Let's talk about today, tomorrow, next week. I can tell you where I think the market might be in a year, but I'm only going to trade to where I think the market's going to be today, tomorrow, next week, and kind of as an active trader. So that's it. Long equity, short natural gas, long Bitcoin, maybe soon short the GDX and gold. Treasuries, I'll have to study the charts a little further. I'll look at the ZB, ZN. ZN is the 10-year Treasury bond. So you can see a little descending triangle pattern right here as I just pulled ZN a little bit with the support right here. I don't have a line there yet. I just hand drew it in. That was a divergent high, and that said that was likely, and it was so far the end of the run. Divergent, just like this was a divergent low, and we were long Treasuries there, if you recall, milking the initial leg up, and there was a trend line break to trigger short signal. So this is what we'll probably do, break that, head down, correct a little bit more. That means bond prices down, yields up as the stock market rallies. And then my vicious cycle begins. I don't know where, let me see if I don't know where it is. I don't have it in front of me right now. Let me just find a clean board. Let me find a symbol I haven't traded in forever. I'll do IEP, Icon Enterprises, just because I know the board's clean. So gosh, it's been over 2 years. I came up with it. I have a diagram somewhere. It's my negative feedback loop in the market. It has three things. It has the stock market, interest rates, and commodity prices and all that. And what happens is equities rally, but then interest rates, which have the equities rally because rates have abated, and then market's happy that rates are falling and inflation worries go away. Then the stock market starts to rally, but then the market can only assume when the stock market's rallying, it's predicting future economic growth and earnings. Therefore, rates will start to then eventually rise, and then the commodity prices commensurately rise with that. And then for inflation is now real again, or at least on the radar, and then the cycle continues, stocks correct. So right now, I think we're in the cycle where very near term where we can see equities go up, and those inflationary things like bonds drop, and maybe gold as well. All right, guys, I'm going to wrap it up here. Just get the video out to you, and I'll continue to hunt for trade ideas. And if I missed anything on the homepage, updates, you want an update on anything, even if it's something I haven't covered, feel free and just drop it in the comment section under this post, ideally. And if you ever miss one, you put it, and I'd only go back for a day or two, and I missed that, just bump me again under the next comment section of the latest post. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.